You find a button. Every time you press it, money appears. No analysis required. No timing needed. Press once, money. Press again, more money. Pure mechanical extraction. Zero consequences. Then you're caught. Mountains of stolen wealth sitting right there in front of everyone. But instead of losing access, instead of being removed from the system, they ask for a taste. 1% of what you took. That's the deal. Pay the fee, keep the button. What do? You pay. Then you press it again. Because it was never a punishment. It's rent. It's overhead. It's what theft costs when the theft is big enough. This isn't theory. This is documented. This is confession. The bank is J.P. Morgan. The button is called spoofing. And the market they rigged is gold and silver. We're going into the files. Department of Justice. September 29, 2020. The day J.P. Morgan admitted to 8 years of fraud and walked out after cutting a check. We're showing you exactly how the machine worked. How fake orders were used to manufacture price crashes. How algorithms created supply that didn't exist to steal from everyone who thought the market was real. And we're exposing the agreement that kept the executives free and kept the rigging operational. They called it a settlement. We're calling it what it is. A licensing deal for infinite theft. This is how they rigged it. This is how they're still rigging it. And this is why the system is about to break. This comes from the United States Department of Justice. Not a forum. Not speculation. Official record. September 29, 2020. Headline: J.P. Morgan Chase agrees to pay $920 million in connection with schemes to defraud precious metals markets. Defraud. That's their word. Fraud. The bank admitted to tens of thousands of unlawful trades. Gold, silver, platinum, palladium. Fake orders across all of them. 8 years. 8 years of systematically manipulating price to damage competitors and crush retail investors. FBI Assistant Director. J.P. Morgan Chase and its employees plotted to unlawfully manipulate the markets and defraud those who trade in them. The largest bank in the United States. The institution holding the biggest pile of silver on earth. Caught rigging the price of the very asset they were trusted to safeguard. But here's what matters. If they were caught in 2020, why are they still trading today? Why is J.P. Morgan still the custodian for the largest silver ETF in the world? Why are they still operating inside the system they admitted to defrauding? Because of the deal. $920 million. In headlines, it looks like justice. Nearly $1 billion extracted. Punishment delivered. In institutional trading, it's a rounding error. The DOJ report covers 8 years. During that time, J.P. Morgan's metals desk generated billions in revenue. Estimates on the actual profit from front-running and spoofing? Tens of billions. Run the math. If a bank steals $100 billion over a decade and pays $1 billion when caught, net profit is $99 billion. The fine is a 1% tax on theft. If you could steal $1 million and the penalty was $10,000, you do it every single day for the rest of your life. This is asymmetric justice. The penalty doesn't discourage the crime. It funds it. The fine was paid by shareholders. A line on the balance sheet. The CEO didn't go to jail. The head of the desk didn't go to jail. A few mid-level traders got indicted. The institution survived. The infrastructure that enabled the fraud is still operational. The machine wasn't dismantled. It was fined for maintenance. So how does it work? How do you rig the price of silver without buying or selling anything real? Phantom orders. The order book is a ladder. Buyers on one side, sellers on the other. Silver's at $25. J.P. Morgan wants it at $24 so they can feel cheap. But the market's moving up. Buyers are aggressive. The algorithm steps in. Places a massive sell order at $25.10. 5,000 contracts. That's 25 million ounces. Instantly, a wall appears. Every other trader sees it. Massive sellers sitting at the top. Supply looks overwhelming. They assume the price is about to collapse. So they panic. They cancel their buy orders. They start selling ahead of the big order. They try to get out before the crash. This selling pressure drives the price down $24.90, $24.80, $24.50. The JP Morgan algorithm watches. When price hits $24, it cancels the sell order at the top. The order was never real. It was never intended to execute. It was a hologram, placed to terrify, removed once the damage was done. Now the wall's gone. But the price is destroyed, and JP Morgan steps in and buys real silver at $24. They bought the dip they created with a fake order. That's spoofing, illegal under Dodd-Frank, explicitly banned, but nearly impossible to prove in real time because it happens in milliseconds. By the time regulators see it, the order's gone. The theft is complete, and the retail trader who got stopped out at the bottom has no idea they were playing against a ghost. The power comes from information asymmetry. The bank knows which orders are real. You don't. When you look at market depth on your screen, you see bars, buyers, and sellers. You assume that data represents actual intent. You assume those participants want to trade. The DOJ confirmed thousands of those orders were lies. This means price discovery is broken. Price is supposed to reflect supply and demand, but if supply is fake, generated by an algorithm that cancels before execution, then price is fake. It's simulated reality designed to extract wealth from anyone who believes the market is honest. The bank is the house in a rigged casino. They see the cards. They control the odds. And when they start losing, they create a fake sell wall and flip the table. This explains the flash crashes. Silver down $2 in 60 seconds on Zero News. No event, no headline. Just a spoof hitting the market, triggering stop losses, clearing the board, then vanishing. Price recovers as fast as it fell. That wasn't a market move. That was a harvest. We know they did it. We know they admitted it. We know they paid. But why are they still trading? Why wasn't the bank shut down? Why wasn't their license revoked? Because of the agreement. The deferred prosecution agreement. The legal structure that let them buy their way out. And because there's a theory, a darker theory, that the government doesn't see the bank as a criminal. They see them as a tool. That JP Morgan isn't acting alone. They're acting on behalf of the system, suppressing the price of gold and silver to protect the dollar. If gold and silver rise too high, the dollar looks weak, and a weak dollar is a national security threat. Could the infinite money glitch actually be state policy? Part 2. We're reading the contract between the bank and the government. We are going into the deal that kept the machine alive. You know the crime now. 8 years. Thousands of fake orders. Price manipulation. Fraud on industrial scale. Confession on record. In a normal system, confession leads to prosecution. If you rig the stock market from your basement, federal agents would be at your door within hours. But JP Morgan isn't a person. It's a systemically important financial institution. And in America, these entities operate under different rules. We're exposing the mechanism that let them walk. It's called the Deferred Prosecution Agreement. We're reading the terms of the deal they cut with the Department of Justice. And we're answering the question no one wants to ask. Why does the United States government want silver suppressed? The bank paid the fine, but kept the keys. This is how the enforcer became the partner. September 29, 2020. JP Morgan enters a DPA, Deferred Prosecution Agreement, legal probation for institutions. The terms were simple. Pay $920 million. Admit misconduct. Cooperate with future investigations. In exchange, the Department of Justice agrees not to prosecute criminally. Think about what that means. The government had evidence. Chat logs. Trade data. Proof of systematic fraud. They could have indicted the bank. They could have revoked its license to trade commodities. They could have shut down the metals desk permanently. They didn't. Why? Because J.P. Morgan is too big to jail. If you indict J.P. Morgan, you risk destabilizing the global financial system. Bank runs, credit freezes, contagion. So the DOJ created a workaround. Extract cash. Let the operation continue. Critics call it cost of doing business. It's worse. It's revenue sharing. The bank steals from the public. The government takes a percentage from the bank. The public gets nothing. Yes, there was a victim compensation fund, a fraction of the total fine. The rest went to Treasury and the CFTC. This creates a perverse structure. The regulator's budget depends on fines. If they shut down the bank, fines stop. So they keep the bank alive. They keep the game running. They just tax it occasionally. The DPA sent a message to every bank on Wall Street. You can rig markets. Just set aside enough to pay the fee when you're caught. But there's something deeper happening here. This isn't just about money. It's about currency. The U.S. dollar is the world reserve currency. Its strength comes from perception. Perception of stability, perception of value. What threatens that perception? Gold and silver. Gold and silver are the anti-dollar. They're the report card on the Federal Reserve. When their price skyrockets, it signals to the world that the dollar is failing. It signals inflation, loss of confidence, system breakdown. A rising gold price is a national security threat. This isn't conspiracy. It's history. In the 1960s, the U.S. government ran the London gold pool. They sold gold directly into the market to hold the price at $35 per ounce. Documented. Admitted. State policy to protect the dollar. Fast forward to today. The government no longer sells gold openly. Too visible. Instead, they rely on bullion banks. Banks like J.P. Morgan act as proxies. They sell paper contracts to absorb demand. They use spoofing to cap rallies. They suppress the price of real money so fake money looks strong. If J.P. Morgan stops suppressing silver, if the price runs to $100 or $200, it exposes currency weakness. It accelerates the flight out of dollars and into hard assets. It threatens the government's ability to borrow cheaply. So when the DOJ looked at J.P. Morgan's spoofing operation, did they see a crime? Or did they see essential infrastructure? Did they see a bank doing the empire's dirty work, keeping the fear gauge broken so the public stays calm? This explains the light sentence. You don't imprison your own operative for following orders. You fine them for getting caught. There's another layer. J.P. Morgan isn't just a trader. They're the custodian. J.P. Morgan holds the physical silver for SLV, the largest silver ETF on Earth. Hundreds of millions of ounces in vaults in London and New York. This is a catastrophic conflict of interest. The entity counting the chips is also playing at the table. J.P. Morgan knows exactly how much metal is in the vault. They know who's buying and who's selling. They have total information supremacy. The DOJ report focused on futures spoofing. It didn't touch the physical side. It didn't ask whether J.P. Morgan leases ETF silver to short sellers. It didn't ask if they trade against their own clients' inventory. By allowing J.P. Morgan to remain custodian, the government endorsed the conflict. They said the fox can guard the henhouse as long as the fox pays rent every decade. This allows J.P. Morgan to maintain total control. They see the flows. They front-run shortages. They use their physical hoard to backstop their paper shorts. This is the infinite money glitch in its purest form. Control the vault. Control the paper. Control the price. And if you get caught, write a check and continue. The DOJ report revealed something else. The culture. Chat logs from the indictment were shocking. Traders bragging about spoofs. Calling themselves the mafia. Joking about crushing retail speculators. This wasn't one rogue trader. This was doctrine. Senior managing directors taught it to junior traders. It was institutionalized, embedded in strategy. Manipulation isn't an accident. It's the business model. These banks don't make money predicting price. They make money moving price. They create volatility where none exists. They trigger stop losses to generate volume. They farm the market like crops, and retail is the harvest. When you buy a silver contract, you think you're betting on metal. You're actually stepping into a cage with an entity that controls gravity. The DOJ proved it. The fair market is a myth. There's no fair market when one player can place 5,000 fake orders per second to move price wherever they want. So we've established history. In 2020, they spoofed for greed. Bonuses. Quarterly targets profit. But something changed between 2020 and 2026. The market changed. Inventory disappeared. In part 3, we're looking at the survival pivot. We're explaining why manipulation today is different from manipulation then. Back then, they suppressed price to make money. Today, they suppress price to prevent bankruptcy. The banks sold too much paper. The physical metal is gone. And now they're using the glitch not as a weapon, but as life support. They're not attacking anymore. They're defending. They're fighting for survival. The DOJ fine was cost of business. The next one might be cost of existence. Part 3. We're moving from crime to consequence. We've established what happened. 2020. Department of Justice caught J.P. Morgan. Proved systematic spoofing. Proved it was strategy, not accident. Designed to extract profit from retail. Back then, manipulation was offense. Bonuses. Earnings. Greed. Fast forward to today. The silver market has fundamentally changed. Vaults that were full are draining. Industrial demand that was steady is exponential. And the manipulation we're seeing now isn't about profit. In part 3, we're exposing the survival pivot. We're showing you why the infinite money glitch has become life support. The banks aren't suppressing price to buy cheap anymore. They're suppressing price because if they stop, they go bankrupt. They're trapped in a short position too large to cover, and the physical metal they need to exit doesn't exist. The predator became the prey. To understand the trap, you need to understand covered versus naked shorts. If you're a bank with 100 million ounces of silver in your vault, you can safely sell 100 million ounces of paper contracts. Price goes up. Doesn't matter. You own the metal. You're hedged. This is how the system is supposed to function. But what happens when you get greedy? What happens when you sell 500 million ounces of paper, but only have 100 million ounces of metal? You're naked short 400 million ounces. For years, this didn't matter. The bank knew nobody would demand delivery. Investors were happy trading paper. The bank collected fees and managed price. Free money. Then the shortage arrived. Solar panels, EVs, battery demand. Suddenly people stopped trading paper and started demanding metal. They stood for delivery. They backed trucks up to the vault and emptied it. Now the bank is holding 400 million ounces of paper liabilities and an empty vault. They're naked, and the price is rising. In finance, a long position has limited risk. Worst case, price goes to zero. You lose your investment. A short position has infinite risk. There's no ceiling. If silver goes to $100, $500, $1,000, the bank owes that money. Let's run the math. Bank is short 400 million ounces. Price rises $10. That's a $4 billion loss. Price rises $50. That's a $20 billion loss. $20 billion wipes out Tier 1 capital of most institutions. It triggers regulatory seizure. It ends the bank. So the bank cannot allow price to rise. They have a solvency ceiling. If silver crosses a certain threshold, call it the kill zone, the bank dies. This is why spoofing has become so aggressive. In 2020, they spoofed to move price 50 cents for a quick scalp. Today, they spoof to stop price from crossing the kill zone. They place massive sell walls not to make money, but to prevent their algorithm from calculating insolvency. They're fighting for survival. This changes everything. The glitch used to be an ATM. Now it's a shield. Every morning, bank traders wake up and look at physical demand. China buying, India buying, price pushing against their neck. So they activate the algorithm. Flood the order book with fake supply. Paint the tape red. Try to convince the world there's no shortage. They hope if they hold price down long enough, demand goes away. Maybe a new mine opens. Maybe recession hits. They're buying time. But time is expensive. Every day they suppress price, they lose more physical metal. Why? Gresham's law. This is the ultimate irony. By using the glitch to keep silver artificially low, the banks are accelerating their own destruction. Think about it. If silver trades at $70 on paper, but fundamental value is $150, the banks are putting silver on sale. They're subsidizing buyers. When Samsung sees silver at $70, they don't say the chart looks weak. They say thank you for the discount, and they buy more. When China sees silver at $70, they drain vaults faster. The lower the bank pushes price, the faster physical inventory leaves the West. They're draining the very collateral they need to survive. If they let price rise to $200, demand would slow. Vaults would stabilize. The bank might survive. But because they're naked short, they can't let it rise. So they're forced to keep it cheap, which forces vaults to empty, which guarantees default. It's a doom loop. They're accelerating toward the cliff because the brakes are gone. You might ask, where are the regulators? Where's the CFTC? We know from Part 2 the government views banks as partners in managing the dollar. But there's another reason regulators stay silent. Systemic risk. Regulators know the banks are trapped. They see the short positions. They know if they force JP Morgan to cover honestly, price goes vertical and the bank fails. A failure that size crashes the stock market. Freezes credit. 2008 all over again. So regulators look away. They allow spoofing to continue because the alternative, a free market price explosion, is too terrifying. They're complicit in suppression because they're afraid of the truth. The infinite money glitch became a tool of financial stability, or at least the illusion of it, so the banks are trapped. Regulators are complicit. Physical metal is gone. How does this end? Does the bank win forever? Does the glitch work forever? No, because you can't print silver. In Part 4, the final chapter, we're looking at Endgame. We're explaining what happens when physical float hits absolute zero. We're looking at the Force Majeure event where paper detaches from reality, and we're delivering the final verdict on the greatest wealth transfer in history. The glitch is failing. The code is breaking. The reset is coming. Part 4. The conclusion. We've exposed the mechanics. We've analyzed the corrupt settlement. We've mapped the trap the banks built by shorting a finite resource. Now we face the inevitable conclusion. Every glitch has a limit. Every cheat code expires. You can manipulate laws. You can pay off regulators. You can hide data, but you cannot cheat physics. In this final breakdown, we're showing you what happens when the infinite money glitch hits the wall of physical reality. We're explaining the delivery squeeze. The moment paper breaks. We're examining the force majeure clause banks will use to escape liability. And we're leaving you with the final strategy to ensure when the system resets, you're holding the asset, not the empty promise. The game is over. Players are leaving the table. For 40 years, the glitch worked because nobody wanted the silver. Hedge funds traded paper for cash profit. They didn't want a 1,000-ounce bar delivered to Manhattan. So the bank sold the same ounce of silver 100 times to 100 different people. Musical chairs with 100 players and one chair. As long as the music played, everyone was happy. Now the music is stopping. Industrial buyers don't want cash profits. They want the metal. When Samsung buys a contract, they stand for delivery. When a sovereign wealth fund buys, they stand for delivery. This breaks the fractional reserve model. If 10 people demand the chair at once, the bank needs 9 more chairs. There are no more chairs. This is the delivery squeeze. It forces the bank into the open market to buy physical at any price to fulfill contracts. The suppressor becomes the super buyer. The algorithm that sold paper to cap price must now buy physical to avoid default. The machine reverses gear. And when a manipulation machine reverses, it creates vertical price spike. So what happens when the bank realizes it can't buy the metal? When price hits $500 and they're insolvent, do they accept bankruptcy? No. They cheat one last time. They invoke force majeure. This clause exists in almost every futures contract and ETF prospectus. It states that if unforeseeable circumstances prevent delivery, the contract can be settled in cash. The bank says, "We can't give you the silver. Market's broken. Here's a check for last closing price." You get fiat back, but you don't get silver. And because real silver price on the street is skyrocketing, that cash is worthless relative to the asset you thought you owned. This is the ultimate rug pull. It converts hard asset owners back into fiat holders against their will. The infinite money glitch ends by defaulting on the player. This is why you're told, if you don't hold it, you don't own it. A paper contract is a bet on the bank's solvency, and the bank is betting against reality. When paper declares force majeure, pricing moves to the parallel market. Spot price on screens freezes or becomes irrelevant. Real price is discovered on the street, between refiners and battery makers, between coin shops and stackers. In Shanghai and Dubai, we move from centralized price to decentralized price. In this scenario, premium becomes price. If spot freezes at $80, but you pay $150 to get a bar, the price is $150. Banks lose power to influence this market because they have no metal to sell. Their algorithm has no jurisdiction here. This is the liberation of silver. So where does this leave you? You saw the glitch. You saw the DOJ report. You saw the manipulation. But instead of getting angry and quitting, you used it. You used artificially low prices to accumulate real wealth. You bought when they smashed price. You took delivery when they wanted you to trade paper. You removed your wealth from their casino. This is the ultimate victory. The infinite money glitch was a wealth transfer mechanism from public to banks. But by stacking physical, you reverse the flow. You use their suppression to buy strategic assets at a discount. You turn their greed into your opportunity. Now, as suppression fails, you're sitting on the only asset that can't be printed, can't be hacked, can't be defaulted on. You are your own central bank. Here's the verdict on JP Morgan and the DOJ. The system is rigged. It always has been. Fines are fees. Regulators are captured. Price is managed. But rigging has a limit. You can rig a casino, you can't rig a volcano. And the silver market is a volcano. Pressure from debt, inflation, industrial scarcity is building beneath the surface. Banks are trying to cap the volcano with paper contracts. It worked for 40 years. The lava is starting to leak. We're entering the era where physical reality overwhelms financial fiction. The glitch is breaking. The game is resetting. And the new game is played with